Yes, all right. Thanks for having me. It's a pleasure to be here. It's a true pleasure reading this paper. I thought it was super interesting on a very important topic. So let me, what I'll try to do in the next 15 minutes or so, I don't know, until Jonathan pulls me out of the stage, is give you sort of a big picture of my understanding of where this paper fits in the literature, how it improves on our understanding of this important policy debate. So why do we have capital requirements? We have capital requirements on banks because banks have a safety net from the government in the form of FDIC insurance. It gives them an incentive to take more risk than is socially optimal. So we regulate how much leverage they can take. If you ask people around the time when, say 10 years ago, when we had a crisis and the bank capital regulation was up in the air and about to be rewritten, if you ask people how much would it cost if you raise capital requirements, well, banks said this is really, really costly. We cannot do that. And they said, you know what, if you raise capital requirements, we're going to have to cut back on lending considerably. And there's a lot of academics that agreed with them. If you asked other academics, they would say, well, it's actually free raising capital requirements. And there were similar proposals that, to adjust capital requirements that have surfaced after every financial crisis, every banking crisis since at least the 50s. You can trace a crisis and then a series of these proposals to raise capital requirements on banks. There are other theories that would say, well, if there's agency problems involved, if you raise capital requirements, you're actually doing the banks a favor. I would say that as a profession, we had very little to say about what would actually be the cost of raising capital requirements, in the sense that we had very few, or I think none, credible empirical estimates of how much that would cost. So that's where we were standing 10 years ago at the time when this policy debate was going on. So since then, I think we've improved a little bit. So Ralph and Modo have a paper of coming up with a nice estimate in the, for life insurers. I have a paper on that subject, which I guess is why I'm here. There's recent work by Fleckenstein and Longstaff trying to do that. There are many interesting calibrations that try to get at that question. My reading of this literature up until this point is that capital requirements tend to be costly during financial crises. Okay, so that's when the shadow cost of capital requirements seems to be high. So don't raise capital requirements in crisis. Okay, outside of them, they are not that high. There are capital requirements in the U.S. and Basel capital requirements are loophole ridden to such an extent that they are largely ineffective. And the third thing that I've learned from the literature is that substitution effects are key. When you think about changing one policy lever, it really matters how you think about how banks or firms change many of the other levers that they have to comply with the rules. All right, so what does this paper do? This paper offers a structural model of the UK mortgage market. It has unbelievably detailed data, something I've never seen, huge credit. I don't know how you got that data, but hang on to it and produce many papers from it, hopefully. It exploits variation in risk-weighted capital requirements across lenders. Within lender across mortgage types. And it has two main findings. One, that a 1 percentage point increase in capital requirements increases interest rates by about 10%, which is interesting. It's a number we want to keep in mind. And the other is that banning high leverage mortgages reduces the competitiveness of the banking sector. This happens in this world because large lenders exploit a regulatory advantage. They are allowed to use an internal model to determine how risky each loan is, whereas smaller banks have a standard that they need to adhere to. I think this is more interesting than just thinking about Herfindahl index of this industry, and I'll explain why. So here's how I like to think about a problem of a bank that's subject to capital requirements. This is a stripped-down version of a model I wrote with Ronnie Kisin. So you think most of this, of what's written here is just standard corporate finance model. There's economic profit here is going to depend on return on assets, less return on equity, return on debt after some taxes. I did add to this a little piece that allows me to think about off-balance sheet debt. Because for banks, off-balance sheet debt is very important. Now, this bank is subject to a regulatory capital constraint that says that its equity divided by balance sheet debt, okay, not the stuff that's off-balance sheet, has to be greater than some number. That's their minimum capital requirement. Now, in this world, the shadow cost per dollar of assets of a marginal increase in the required capital ratio is captured exactly by the Lagrangian multiplier on this constraint. Right? It is telling me what is the effect of a small increase, small has to be small, right, around where they live right now, of a small increase in the ratio on the profit, what's the private cost of this institution. Now, there are several margins you can look at that the bank can adjust, and they would all potentially reveal that same shadow cost, that same Lagrangian multiplier. So, for example, you can look at what happens when you change it to how banks respond to how banks change their equity. If you raise capital requirements, banks can also comply by selling assets or moving them off balance sheets. So I can look potentially at the margin of substituting between equity and off-balance sheet debt. I can look at substituting between equity and book debt. I can look at substituting between balance sheet and off-balance sheet debt. Or I can look at what happens when I change something here on the liability side to the asset side, which is where this paper lives, right? It's about what happens when I shock, when I force the bank to sort of change their capital structure, what happens, what do they do on their asset side? All right, so the traditional approach, and this is sort of, in one picture, where's the debate between the banks and academics that believe in Modigliani-Miller. If you just did the simple exercise and said, okay, let me look at substitution between equity and debt. Well, if I substitute a little bit of debt in favor of equity, then I'm going to have to pay the return on equity less whatever I used to pay on debt. So this is cost of equity versus debt. That's a number we can quantify. There's another effect that's going to come if I substitute from equity to debt, which is the leverage effect on the cost of equity. Right? If I increase equity, that's going to change the price of equity. And the price of equity will also change when I change my debt structure. And to go from that to what the impact of that is on the profitability of the bank, I also need to know what's the regulatory capital relief. If I increase equity, how much closer am I to complying with the rules of the regulator? Now, this leverage effect here is really the source of contention, right? This is why the sides disagree, because practitioners often focus on this part here. Ignoring completely the one on the right, many academics appeal to Modigliani-Miller type arguments and focus a lot on what this does and say, well, if you add them up together, for example, in Modigliani-Miller taxes, the whole thing is just RD times tax rate. Okay, so I would say that putting your finger on this quantity is very challenging empirically. What Ralph and Moto did was they looked at life insurers and they applied a framework that's very similar to what Matteo is doing, a BLP model, a structural model from the IO literature. And the cost of producing such a model is that you need to specify the technology of assets, you need to specify consumer preferences, you need to specify elasticity or estimate all of them. And they found that the shadow cost of increasing, the shadow cost per dollar of regulatory capital for the average life insurer is almost $1. Sounds high. In November 2008, okay, So the number that made their abstract is this point here, right? I would just point out that there are many periods here where they're estimating the shadow cost to be exactly 0. Okay, so the capital requirements are not binding for life insurers in a lot of this figure, in a lot of this sample. Now, these structural estimates come from the first order condition for optimal product pricing, like in this paper today. Now, there's another way of going about this problem, which is to ask, what happens if I substitute on-balance sheet versus off-balance sheet debt? We call this a loophole in our paper, and we have one such there. The advantage of that is that now you have two terms that you need to think about. One is the cost of off-balance sheet versus on-balance sheet debt. That's a number we can easily measure. You need to potentially think about how using the loophole affects the cost of equity. And it turns out for a loophole, this doesn't matter for a regulatory loophole. And the denominator is also easy to measure. What this approach gives you, the loophole approach, is an estimate per bank, per period, of what's the shadow cost of bank capital requirements. So we did that. We came up with really small numbers. Okay? I'll skip that. What is this paper's contribution, as I see it? So I think that I would change a little bit how I position the paper, because when you position the paper, you say that you can explore more granular variation in risk weights within lender across asset class to identify this elasticity. But if you just stare at Ralph and Moto's abstract, this is how they described their paper. They kind of already did that. Mortgages have also been modeled similarly with a BLP model by others recently. Where I think this paper should distinguish itself is by helping the reader see through the black box of a structural model, by using many more interesting counterfactual exercises like you do and pushing them up, and by focusing on this internal versus standard model. I think that's where it really has a benefit. So I'll give you 3 suggestions before Jonathan pulls me out. The first is, if you look at the summary statistics that you report, it's not clear at all that capital requirements are binding for these banks. The minimas are something like 12 for the average bank here. Capital ratios for these banks are way larger. Okay? I believe that they are binding for the largest banks. I have looked at that, but you have banks that I've never looked at. And I think bringing some evidence to that effect would help. The second suggestion is, a good structural model makes a bunch of reasonable assumptions about the data generating process, and the estimates all come from there. A great structural model, for example, the Lucas model, can point to a single equation that pins down a parameter. And this is very hard to do, right? A compromise that we often use is to report some intuitive descriptive statistics, like an IV regression, that we sort of believe. It has, it's not perfect, but it's better than nothing. And then compare its estimates to what you get from the model. So it's not clear, I would say, what we learn from the IV estimates about the structural estimates that you get from the data. There's a recent work by Andrews, Gensko, and Shapiro that helps us think about how this type of exercise helps us inform our confidence in the structural model. And I think reporting some of their informativeness statistics can help. Third, you have 2 counterfactuals that I think are interesting. One is, what happens if you increase capital requirements by 10 percentage points? This is something that Hansen, Kashyap, and Steins started in 2011 with sort of a very back-of-the-envelope kind of exercise. We have a much lower estimate coming from data. Baker and Rugler have another estimate. You come up with an estimate of 60 basis points, and you mentioned this twice in this presentation, and it is mentioned somewhere in the paper. This is an upper bound, right? It's an upper bound because we're increasing capital requirements, but banks cannot raise equity, right? The only thing that they can do is delever. Yes, that will definitely be costly. They will definitely reduce mortgages at that point. What I would say is, First, it's not clear to me why you cannot do more with your model. You have a full-fledged model. I would expect you to be able to do more. But two, if this is all that you can do, I think that belongs in the abstract in the introduction, the fact that this is an upper bound on what can possibly happen. The fourth is that you have really interesting results on competitiveness of the banking sector. What's missing for me, I'm not in IO. I know the IO people really care about competitiveness of many sectors. I care much more about too big to fail guarantees. And I think that if you change the competitiveness of the banking sector, you directly change the problem of too big to fail. And I think making that link in the paper can help make this more interesting. I will just point out, you make these estimates here about consumer surplus. You showed us lender surplus in the presentation. Government surplus doesn't appear anywhere here, right? What these exercises, counterfactual exercises, do to taxpayers is completely outside of this model. And I think that discussion of that belongs there. So my take, I think there are way too fewer papers that measure the potential for policy intervention in banking. I think we should be better able to educate the policy discussion in the next crisis, which will probably happen a few years down the line.
Okay.
Thank you.